Hi, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for April 20th, 2015. This week I want to talk about strategy equity curves. Let me first explain what I mean by strategy. I'm a strategy trader. That means I buy when a set of rules are satisfied, I manage risk based on a set of rules, and I exit based on a set of rules. It's possible to take those rules and program them into a computer and have the computer actually trade the market. Now, I execute my rules manually with the help of a computer, but on a daily basis, I can identify all the stocks that met my criteria, put them into a spreadsheet that documents how that strategy performs over time. And I can then graphically show that performance in what's called a strategy equity curve. It's how our profits have grown over time. Now, ideally, equity curves should have a consistent upward trend. We want them moving up from left to right without a lot of volatility, without lengthy periods of pullback, because if there is a lot of volatility, let's say you have a day where you make $5,000, but then you have 2 days where you lose $3,000 a day, and then you make $7,000 and you lose $6,000, that volatility gets frustrating. We also don't want periods where our profits consistently lose over time, because that can also be frustrating. So what we want in a strategy equity curve is one that is sloping up from left to right with a fairly consistent trend. Now, we can do all of this in Excel. There's other software programs out there specific to trading that will allow you to test the performance of a strategy and graph the equity curve. However, I just do it in Excel. I'll say these 6 stocks met my rules today. I bought here, I sold here, and I plot all that overall profitability for each trade, and I accumulate those trades in the strategy equity curve. So here is, for example, a series of strategy equity curves for one of my day trading strategies. This is the day trading strategy that I do just about every day. And you can see it's had 112 trades. This is about over a 5 or 6 week period. And the different curves you see there, that there's 6 different ones on there. The reason I have 6 is because I have different exit strategies. So what I've been doing is testing different exit rules. The topmost line is the best performing exit, but all of the lines have the same entry rules. So you can see the top performing strategy for the exit using the same entries is up about $120,000, $130,000, whereas the worst performing exit set of exit rules is up about $75,000. So the difference is nothing to do with the entry, it's just the exit. But what you should notice is that the trend of these equity curves is pretty consistent, moving up from left to right. Now, there was a period here in the middle where it kind of trended sideways, and then another period here where we had some sideways trend, and then last week it was pretty consistently moving higher, and that demonstrates how the performance of my strategy is working over time. And it's real important to do this to really see how well your strategy performs over time. All right, let's take a look at the S&P 500 short-term chart. You can see that the market was doing pretty good over the last few weeks, but on Friday we had that big sell-off which broke the short-term upward trend. Now, we're still stuck in that sideways trading range. We're below the red line of resistance. We are above the green line of support, and it looks to me like we could see more weakness. We could see this bottom line get tested again. So generally in the short term, we're in what I would call a neutral market because we've been trending sideways. The upward bias that had been placed over the last 2 weeks was broken on Friday, so expect some more volatility next week. The long-term trend for the S&P 500 is still up. We have rising bottoms from left to right. We are moving up towards that flat line of resistance that I have drawn in red. And as long as we are below that, we're going to be stuck in the sideways range. But what's encouraging is that the volatility is diminishing over on the right-hand side. What I mean by that is the amount of price movement is getting less and less, and that typically comes before a breakout to the upside. As long as this green upward trend line is not violated, I remain bullish on the overall US stock market. Here's the Russell 2000, which is the small cap index. It has been outperforming the large caps, but it too got hit on Friday with some selling pressure. Didn't break the upward trend line, the more shallow upward trend line that I have on the chart right here. And so we're still in good shape there, but we do need to see that line hold. Now, looking at the longer term chart, you can see that we're still in an upward trend on the Russell 2000. We recently broke out to new highs, whereas the S&P has not been able to do that. So the small caps are outperforming the large caps, and I think that's where you want to trade in the US. In the Canadian market, we had a pretty good rally underway over the last 2 weeks, but it was broken on Friday by that weakness in the global markets. That weakness in global markets was caused by concerns in Greece, some curbs that took place in the Chinese stock market. There was even a computer outage in the US on the Bloomberg system. All of those things combined for some weakness on Friday. Thursday actually is when the TSX broke its upward trend line, but this is still a reasonably healthy chart in the short term. Long term, we're stuck in a sideways trading range, much like the S&P 500. The TSX has actually caught up quite well. It had been really underperforming the S&P 500, but it too rallied up to resistance and got stuck. Wouldn't surprise me if we see a little more weakness in the next week or two, but the bias here is to the upside, and so I still remain long-term bullish on the market, although right now we're kind of in a neutral situation where we're trending sideways on both the short and medium terms. TSX Venture has stabilized quite nicely. It's been in trading range for about 4 months, but it still can't catch that optimistic bid in the commodity space. The strength in the TSX Venture is in technology names and some of the biotech and healthcare names, which make up a relatively small portion of the overall TSX Venture market. So I think you have to be very stock specific in how you trade the TSX. Commodity sector still not very good. Here's the Treasury bond market. It is building a falling top. You see here we have a top that is lower than the last top, and that is a sign that the sellers are taking control, and that really points to the expectation that interest rates are going to rise. We haven't broken the long-term upward trend line though, so you remain optimistic about bonds, but with that falling top, I do want to have a little bit of extra caution in that market. US dollar forming some falling tops. We're starting to see some pessimism creeping into the US dollar. Even though you had problems with Greece last week, the US dollar didn't rise. In fact, the euro did okay, and that was a bit of a surprise to me. That kind of points to the fact that everyone buying the US dollar has become a very crowded trade, and I think that some money is starting to take some profit in that US dollar. Long-term trend is still up, and so we shouldn't get too pessimistic about this market. Just expect that we're going to continue to see a little bit more of a pullback in the US dollar. Gold, generally in a downward trending market, not a very steep downward trending market. It's relatively shallow, but you want to be somewhat cautious with gold still. You can trade some of the stocks, but you have to be very short-term oriented in that market. The oil market has rallied over the last month and a half or so, maybe month, and it's now up to resistance. So I think people were starting to get a little bullish on the oil stocks last week, and I would caution, because I do think we're going to see a stall in that upward trend in the short term. I do think that things are definitely improving in the oil market, but I don't want you to get too bullish on oil stocks just yet. Maybe own 1 or 2, but don't jump into this sector with guns a-blazing, because it still has a lot of work to do to reverse that long-term pessimism. The fear index had a little bump up on Friday, but we're still in a downward trend on fear. The market is still not too worried about a major event causing a major correction. And so I think that you can be relatively confident that the stock market is still healthy, but certainly that's something we always keep an eye on. So long-term trend for the US market, bullish, neutral in the short term. Canadian market's been kind of trending sideways for a while, so I've got a neutral rating on both the short and long term. Bearish on the long term in gold, neutral short term. Bearish long term in oil, neutral short term. Markets continue to lack commitment by the buyers or the sellers. The real long-term trend is up, but the short and medium term shows this aimless trading, this complacent trading. We need volume. We need the market to have an opinion. And in that environment, I want you to focus on alpha stocks, those stocks that are trading abnormally in the hot sectors. That's where the action is. US dollar is showing signs of weakness, which could help commodities, but the trade is still not there yet. Something to watch, but still not there yet. Fear is relatively low, so I don't see a reason for concern about a major correction, but of course that can change very quickly. Well, that has been the Stockscores Market Minutes for April 20th, 2015. Have a great week in the market and trade well.